Right, good morning, everybody, and welcome. First of all, from my side, a special welcome to the Honourable Minister Lebogang Totanyana from Lesotho, who's our Minister of Mines and our partner, also with his colleague, the Commissioner of Mines, Mahali Radikariki, who's also come for the trip to London as we're going through this whole week. And to our Chairman, Lucia Genovese, and the rest of my team that are here helping me and helping us deliver this project. We've got Grant Ferryman, our Chief Financial Officer, Glenn Black on the end, our Chief Project Officer, and sitting next to Lucia, Paul Bosma, who's our Chief Operating Officer and Group Competent Person and looks after the mineral resource and most of the technical aspects of the project. In the audience today, we have a selection of analysts, shareholders, and other interested and affected parties that have all been very helpful in getting this project to where it is today. Why are we here today? Well, traditionally, we normally have our year-end results, and we come across to London. We spend most of the week prior to that knocking all the numbers together, Grant battling with the auditors, and over the last couple of years, all we do is report a loss. So we thought, just coming to tell you we made another $10 million loss wouldn't be the most exciting thing we've done, and really what we want to talk about today is the project. And if I take a step back to where it was 2 years ago, I just started working for Firestone Diamonds and indeed Lekabong up in Lesotho. Prior to that, we were thinking about doing this, and this project had effectively myself, Grant, and Lucio on board with a few other people. And over the last, let's say, 2 years, what have we done? And that's the story we're trying to tell you today. Our focus is going to be really on the project, because that's really what you want to hear about. We want you to walk out of here understanding that the project is well advanced, well managed. We will be touching on the support that we get from the government, so that's hence the Minister being with us today. We want you to understand that we've done everything from scratch and we've started over again and we've owned everything we're going to present today. Our intention is to bombard you with lots of pages in front of you, but we're not going to go through all of that in a lot of detail. It's to tell the story of what we've done so far. The challenges we faced, we will be very honest about those in terms of the weather, the overburden, the building of the new model, and each member of the team is going to take you through that. If I take the financial results out of the story, it's a lot of ownership of this project and building the team. We now 15 months into the project, 24 months into the life. When I go back to when I started, when I first joined this, and I met a lot of you sitting in this room for the first time, and a lot of people are very honest with, why have you joined Firestone? And I still remember, it's a good project. There's nothing, you can't take that away. The resource is there, and we're going to be showing you that today. And we can build this. We have the right amount of capital, and Glenn's going to give you all the confidence and show you lots of pictures of why we are confident that we can deliver the balance of the project in the time that we have left, and that we have the money. A lot of you and a lot of other people said, well, you'll never deliver that. You want to raise $200 million. And I'm reminded of when I was growing up. I once found, living in the UK, a fox that dug up a rabbit warren, and there were a lot of little rabbits sitting in there, and I was about 7 years old, and I managed to find 2 of them still alive, and I took them home to my dad, and he said, well, you've got to do this and feed them milk. And then he went to the local pub and he was telling all the local farmers that young Stuart had just found these rabbits. And the local farmer said, in really straight language, you'll never keep those rabbits alive. He didn't quite say it like that. And 6 months later, I had 2 big rabbits running around the garden and they were sort of bounding around. My dad was telling the local farmer, and all he said was, I'm very surprised you kept those rabbits. He didn't quite say it like that either. And it reminds me of when I was going on the funding. Well, I've got, the first part of the funding sorted out. We've got 2 very interested and very supportive shareholders in Resource Capital Funds and Pacific Road. Okay, well, apart from that, you'll never raise the balance. Well, actually, we've got the bank on board, and they're in partnership with these 2 big shareholders, so we're kind of nearly there. Well, you'll never get those guys, beyond that. Well, actually, we've got some very good cornerstone investors, and we're going, and then blame me if we didn't raise all the money. And then it was, well, you'll never build this thing because it's too difficult, it's too hard, and well, we're 50% complete, and we're a year and a bit into the project. So without further ado, I'll jump into a few slides. I'm not really going to take you through any of the detail. Done the introduction and welcome. Glenn's going to take you through really the construction update, where he started and how far he's got. Paul will take you through, and there's a bit of detail here. He's not going to hit you with all the detail on the slides, but he's telling you the story of what we've done and what we own from this whole project and why we've done the work we've done and why we're so confident that we have so much revenue in the ground. Then have a bit of a break where I'm sure you will have lots of other questions. There will be a time for questions right at the end of the presentation. We've left adequate time. We really would encourage we have some debate at the end. I've brought this team all the way from Lesotho in South Africa to spend time here this week to make sure that we are ready. And it's your opportunity to engage, discuss the risks, things that concern you, that we can allay your fears and give you confidence that we've mastered the risks that we face up in Lesotho. Grant will then end off by telling you about the financial model and how much money we've got left. And then I'll touch on the market overview about what's happening out there in the diamond industry. Obviously, there's a lot of interest out there right now, and there's a lot of commentary about that. We've got some very interesting analyst reports that go out about what's happening in other sectors that cause various share prices to go up and down. We want to leave you with the confidence that we think the timing's right in Lesotho in terms of where we are in the project, and the fundamentals in the diamond market are really there. And then Lucia will end with some closing comments, and then we'll have the opportunity to answer any questions, and you can ask anything you like. The usual disclaimer. I'm not going to go through any of these points here, other than to say the net result of all this work is we have a very solid mine plan. We have the robust economics that we've really tested and reconstructed from zero right on. So we've given you all the data we think you need in terms of our metrics, our operating costs, our capital costs. We told you about the risks, told you how much cash we have, and we do think that we're in a great position right now. Just for those of you that aren't entirely familiar, Lesotho is an independent country surrounded by South Africa. It's not a province of South Africa. It doesn't get governed by South Africa. It's entirely independent, run by a democratically elected government. It's headed by the King, King Letsie III. He is much like the Queen in the UK. She is the government head, but plays no functional role in running the country, but is the head of Parliament and opens Parliament, addresses Parliament. But that is at the behest and the request of government, and it's a very good system. We're very happy with our relationship with government and in the functional economics of working in Lesotho. As I was saying earlier at the breakfast and with the Minister, we're right in the province of finding where you want to find kimberlite bodies. So we're sitting surrounded by 4 other big kimberlite deposits, and the best place to find a mine is right next to another one. So our resource, our information is, backed up by our neighbors. So it's a great place. If you're coming to look for new mines, that's where you have to go in Lesotho. And that's part of the government's drive to try and attract new exploration. And it's dependent on the success of companies like Firestone that we're able to deliver that message on behalf of our partners in government, that Lesotho, you can work there, you can function there, but you have to talk to your partners regularly and work very closely with them. And if you do that, generally, life's pretty good. John, can you just pour me some water, please? Thanks. The slide I will spend some time on. We've been working now 15 months. We have some 680 to 700 contractors on site, excluding our power contractor, and that project's now largely come to an end as we completed it last week. We've worked so far just over 1.3 million man-hours without a lost time injury. And when you get to see the scale and the size, and some of you as shareholders have been, and analysts have been up to site, I think with the multiple contractors, the weather, the close environment, the narrow valley, I think that's a fantastic achievement, and led by Glenn and all of the project team and the contractors, we're very happy with that. Working with our new community, we've had to build a new road. We've paid preliminary compensation to the community because we have taken a large chunk of the road, has taken a lot of their grazing. We recognize that water management in the community, morning Mark, is very important to us. Water is a critical resource for the country. It's one of their biggest exports, but you've got to keep it clean and you've got to make sure you don't fill the dams up. So there's a lot of work that's done, a lot of capital's gone into managing the water access and quality and making sure that we can continue to provide clean water to the community. And I make that point because it is a national asset and we are digging in people's backyards. Effectively, we're affecting the local community a lot. We're in the final stages of negotiating our compensation for loss of grazing land. We've built a mine over about 3.7 hectares of ground that we now want to fence in. And at the moment, we share that ground with donkeys, cattle, goats, sheep that come past. And that's not an environment that's either safe for them or safe for us. So we have to work closely with the community, and we're doing that right now. One of the things that we're going to do in the environment and also the community, we want to keep our workers safe, we want to keep them healthy, and we want to invest in them, and the best way of doing that is making sure that their health is looked after. We currently have a clinic on site, but it's our temporary clinic. When we finish, we will have built a fully equipped clinic. We hope to attract the right staff there. We've got paramedics and occupational nurses, but we want to employ a full-time medical doctor. And then the clinic will be open to the local community as well, which is the Likabong village and the Polani village. We'll be completing that next year, and I think that's a big step forward in the electrification process, the health management process, and the simplicity of water management. We also invaded a lot of the areas, and we are disrupting the lives of 28 families because of the risk profile of the mine and building the slimes dam further down in the valley. There's a potential for those families to, if anything goes wrong, to be affected by that. So over the last 2 years, we've spent a lot of time negotiating on the relocation of 28 of those families, and indeed we're right now in the middle of that process. We've got compensation and agreement and movement. We've nearly finished the construction, and we hope to be finished by the end of the year, of the 26 new houses in our valley, and 2 of the families elected to move to another valley near Laribi in doing that. So I think we've still got a lot of work to do with our community. It's like your next door neighbor has finally built a new house next to you, and it's taken 18 months so far, and you had 18 months to go, and all you, as a citizen of Likabong, want is, will you guys hurry up and finish, because we're sick and tired of all the trucks rolling past and doing all the damage to the area. When we get settled with that, we will be working very closely with the community. I think the project of Glenn's team have had to spend a lot of time working with the community, and it's a process of going backwards and forwards. It's an area where we're coming to bring a lot of sophistication, a lot of infrastructure to what is pristine, absolutely beautiful mountainous areas in that, and hopefully Glenn will take you through those. So without further ado, I'm going to move on to Glenn, but just a reminder of this is really what the size of the prize is for us. It's the large stone population. It's the very popular incidence of high fancy yellow stones. We're not making a big thing of our large stone potential today. We've done that before. We do have every confidence that we will recover the large stones, but our base message to you is our base model delivers an excellent return, and that's what we're focusing on. Everything to do with large stones is upside. So without further ado, let's get into Glenn taking us through this model. Thank you very much.
Thank you, Stuart. As Stuart said, I'm the Chief Project Officer. I, together with a very competent and experienced owners team, are responsible for delivering the project. Just reflecting on the experience of the current team across all disciplines, we currently have 120 years of De Beers experience in the team. So if we can't do it, nobody's going to do it. I think that's the message we're trying to give there. Just moving onto the project schedule, I'll be looking today, I'm responsible for the execution, I'm responsible for the schedule and schedule delivery, and I'm also going to be talking about the project costs. So we started, as Stuart said, back in June of 2014. The original baseline schedule took us through to June of 2016. That's the black line at the top there. And we had an original project cost of 1.85 billion rands. We have had some delays, as Stuart again alluded to. We've had work permit delays in the early days. We've had some weather delays and serious weather and inclement weather through the first rainy season that we encountered. We've also had some significant overburden delays. Thank you. Overburden increases. So we've had to put up with that. I think we went to the market in June of this year and informed the market that we were expecting to now finish the project around the fourth quarter of 2016, around here in the blue line here, and that the project costs had increased by some 156 million rands. That took the current project cost up to 2.1 billion, but within that 156 million rands, we have obviously the costs for the increase for the contractors, There are extensions of time. We also have some acceleration costs. So we've made provision to accelerate this project, and our intention, with the assistance of the government of Lesotho and the work permit applications, is to accelerate away from that December 2016, back as close as we can to the original project, but right now we're currently thinking we can comfortably make, at 50% today, we can comfortably make October of 2016. Just as, again, Stuart pointed out to you, in fact, just to make that point, we have actually started accelerating in some of the areas. So some of the earthworks has been accelerated, some of the civils has been accelerated, and we'll continue to pursue those opportunities. So right now, we're sitting at 49% complete as at the end of September. We're 15 months into the project, we've got 15 months to run, so we're very confident that we can make the December or quarter 4 date quite comfortably. Okay, as I said, project cost to date, or currently at 2.1 billion. The contract basically is an engineering, procure, construct, and management run by DRA Projects. But because of the experience of the owners team, what we've done is we've integrated our owners team into that project with a view to managing a lot of the site facilities. Just in terms of some of the major contracts, we have a residue storage facility, we've got civil and earthworks, structural, mechanical, platework, and piping. And I'm going to go into a lot of the detail of that in the later slides. So this is really just for information. Where are we from design engineering perspective and procurement? We're at about 90% complete. We have had some slippage on the design and engineering as a result of another slippage, which was the mountain slippage in some of the main plant areas. We have monitored that, we've managed that, we've cleared that. We now have a ground operating radar that monitors any slippage, and I'm quite happy to say that it looks like that slippage is behind us. The only outstanding design engineering currently is the interface between electrical and C&I. And there are only a few drawings left there, together with some piping detail. From a procurement perspective, we are comfortable that we've got all of the equipment procured, and in no way will procurement impact on NDS schedule activities. And I'm going to be showing you some of the equipment that's already been delivered to site, and the majority of which is in Johannesburg waiting to be delivered to site. Okay, so Paul's going to talk a little bit about the main pit here. So this is just an aerial view of the site. So coming out of the main pit, we come on to the ROM pad here, and then round to refueling bay, workshop, and through the plant facilities. In the foreground here, we have the residue storage facility and the water storage dams just to the right here. So if you can just take a snapshot of that, I'm going to go into a little more detail on the next slide. The next slide basically was that road coming out of the pit. So we come onto the ROM area here. We have 3 to 4 days of ROM storage capacity in the event of rain or snow. And I must just say that we are moving into a rainy season now. We've just come out of a snow and dry season. We've had some very good productivity levels through those seasons. But we obviously we'll be monitoring very carefully as we go into the rainy season. Looking further down, this is the earth moving vehicle refueling bay and the workshops. These are not on our critical path. These, for the first 12 to 18 months of the project, we can in fact use the existing facilities. So we're not really focusing on those, although we are looking at the contractual implications at the moment. This is the primary crusher here, and I'm going to show some detailed photographs of that a little later. And this is the conveyor, the main conveyor going up the scrubber building. I just wanted to put this whole thing into perspective. This scrubber building is approximately half the size of a football pitch. It's about 50 by 100. 50 by 100, is that about half the size? Somebody help me. Just to put it in perspective, it's about 500 tons. So these are not insignificant structures that we're dealing with here. Moving down, we have the DMS and recovery. We have 250-ton fines and coarse DMSs that surround the recovery with the equipment going straight into recovery. And we have the latest X-ray technology or personnel X-ray technology included in our estimate to ensure the security of product at source. Another area of a critical area for us is the thickener area here, and that thickener is really to densify the material that's sent out to the residue storage facility so that we can retain as much water in the plant. As Stuart said, water is a critical resource in Lesotho. Okay, so where were we in July of 2014? You can see we basically just had a big mountain here. And this is where we are in August of 2015. This is really just to orientate you and show you the major areas of construction. And I'm going to go into a little bit more detail individually of those. Earthworks, we almost double in terms of the quantity of earthworks that we had to move. And some of the later slides will show you how much we had to cut into the mountain to get to a solid base rock to facilitate the building of the plant. But the critical path earthworks are now complete. I'm pleased to say we're at 70% overall, 76% overall. And we expect to demobilize the earthworks team by what we call our contractor's break, which is around mid-December. So the majority of the earthworks team will have left site by the middle of December. In 2016, we'll only have small works, civil crews finishing off around the plant. Again, looking at the main plant terrace as we move through February 2015 and on to September 2015. So the view from here is we're looking down from our electrical terrace. I'm very happy to say that the electrical reticulation, the grid power, is now switched on. I have other slides later. But we also have done the internal reticulation at 11 kV from the main substation, the 132 substation, to site. And we have our internal mini-subs and substations energized. So we're looking down from that terrace, from the electrical terrace. This is what we call our -6 level. Again, more details to come. This is the thickener area here. This is our recovery and what we call a reinforced earth wall here, moving up onto the scrubber level. And then the final level is 8 meters above that, and that's the earth-moving vehicle workshop and our refueling bay. This slide, if you could see here, it does come in a little more detail later. Just here, as you can see, you're getting an understanding of the extent that we had to cut into the mountain to get to solid rock there. This is the raw water dam. This is finished some 4 months ahead of schedule, about 100,000 meters cubed of storage capacity. It's also part of the residue storage facility scope of work. We're very comfortable with that, and we will start to fill this as the rains come through November and December as a secondary storage facility for us. Moving on to the residue storage facility. We're about 82% complete. We expect to finish this work about 5 months ahead of the original schedule. This has been a particularly good contractor that has worked for us, or with us. I've got to say that the collaboration on site between the contractors when we first started wasn't too good. We had our problems. But as time has gone on, certainly these guys, we redeployed these guys to make sure that we get the earth-moving terrace, the main plant terraces into a shape where we could accelerate the civils, and they've been very accommodating in that regard. So these have been a really star of the show. And just to put it into perspective, this was the toe or the new Slimesdam wall way back a year ago in September 2014. This is it today. You can see the extent of it. We've put about 2.5 million tons of material into that wall, and we've got a little over 500,000 to go. If you could just cast your eyes here, you'll see that this is actually the contour of the final dam profile, and that's what we call our starter wall. That will be ready. It'll be available for us to start mining, and we'll be able to retain about 12 to 18 months of residue in that. Also part of the earthworks contract, we built a 5.8 kilometer road from what we call Chainage Zero into the mine. And this was really to facilitate the delivery of all of our major equipment. You can imagine there's some very large equipment coming. I think the major loads are about 50 tons. And getting them up and through the mountains of Lesotho is no mean feat. We also have about 300 tons of steelwork, 300 trucks of steelwork coming for the 4,000 tons that we're expecting on site. And the new overhead power line on the right-hand side here, it is coming from Halajoni substation. We've just energized that on the 2nd of October, about 9 months ahead of schedule. And to the right, we have Palani village. As we said, Stuart said, we take it very seriously. We have given access to the villages along the way, secondary accesses, and I think that has been well accepted and well appreciated. It was around 36 million rand to build that road. In terms of civils are doing really well. I'll show you some slides just showing where we're going with the civils. They are getting late access, unfortunately, as a result of the delay in the earthworks and the increased overburden. But we do really need to accelerate away, because then we have to give access to our structural, mechanical, piping, and platework people. The point I wanted to make here is that we've started pouring. We say we were at 800 meters cubed complete. We've got about 4,000 to go. The point I'm making here is that this pour here is the largest pour that we had to do. It was 360 cubes. It happened over about 30 hours, and the guys worked right through the night, obviously, and into the next day to make sure this was complete. This is the actual finished product here. This is a foundation for the recovery building and the sort house building. So we're basically ready to start with the brick up from ground zero there. In the background here, we have what we call our earth wall, the earth wall, sorry. And at the top of that, the foundations for the recovery interface and the DMS have already started as we speak. Just taking a look down from the EMV terrace, I'll start here in the top left. So we're looking here at the scrubber and tertiary crushing building. What we did, because of the delays in the earthworks, we took the opportunity to build the reinforcing, to fix the reinforcing off-site. These two areas here is just showing you this is where the actual scrubbers go. The scrubbers are about 40 tons. They go, this is the blinding for the scrubbers, and this is the reinforcing that will go in there. And we've actually been able to precast a lot of this foundations as well. On the right-hand side here, we have the tertiary support system, and we will be putting the tertiary crushers in by the end of November, so we are really making some progress. And I'm informed as recently as this morning that we've started with other retaining walls around this area. In the top right here, you see the recovery in the background, and in the foreground we have the thickener foundation. This was also a pour done over last weekend, a large pour, one of the larger pours, 160 cubes, and this is really showing you, again, showing the outer ring of the scrubber, it's the thickener, apologies, and we're basically in the position shortly to start erecting that thickener. Again, if you just look at the sidewall here, it gives you an indication of what we had to cut into to get down to solid rock. And above us here is the road in, the new access road, which will pass the mine and round into the earth-moving vehicle workshop and refueling bay. Accommodation, that's an area that has given us some problems. We're a little bit behind schedule on the accommodation, and of course we need that accommodation, number one, to house the contractors that we have on site currently, and number two, to house additional contractors and staff for the acceleration program. We are working hard to it, and having said all of that, in January of this year, this is not any of the accommodation, this is the camp for the accommodation contractor. This is what we call the lower terrace, and on the right-hand side you can see that we've already completed 13 of the 24 units that we will be building. So we are making some progress, but we're not just keeping up with the requirement for additional contractors, even though we are doubling up on beds to try and facilitate that. Construction progress. We're very comfortable with the 4,000 or so tons of steel that we have to manufacture. It's all up in Johannesburg being fabricated and ready to be shipped to site. So it's 73% complete. What I'm just showing you here is the earth-moving terrace, where we have the scrubber building, which is already arriving at site, and the majority of the steel now will start to be shipped sequentially to the site. This is the SMP. Apologies, they're at 2.3%. So this is the SMPP. This is structural, mechanical, piping, and plate work. These are the guys that need the civil foundations, obviously, to get more access. We will have 8 or 10 teams working, depending on the acceleration program. We'll have something like 14 cranes on site at the peak of construction, and they'll have somewhere in the order of 200 to 250 people. These guys established site only in August of this year. As I said, there's in this contract, there's 4,000 tons of steel. 17 kilometers of piping to go into that into the plant facility. But you can see already that they are making very good progress in terms of steel erection. It is dangerous work. It is working at height. So we do need the technical skills and the and the other skills and the steel erection skills just to build these areas safely. Looking here is just from this area, looking out on the transfer tower, and this is effectively complete and handed over, ready for electrical. From the transfer tower, that conveyor that I referred to earlier goes up to the scrubber building, and we should have that installed by the end of 2015. Again, the equipment is all in Johannesburg. It's all waiting to come down. This is what we call the apron feeder and the flow conveyor. This is the actual apron feeder itself, and this is the whole facility complete here. Also part of the primary section is the jaw crusher, and you can see we have made reasonable progress. As I said, the contractors are willing, the steel is available. We do really just need those technical skills and work permits to move forward. Taking a step away from the facility, this is the power line, the grid power. This was back in a year ago, effectively, where we were building the terrace, or drilling and blasting the terrace for the substation. The substation is complete. The line is complete, 28 kilometers of line. The switch in at the Halajoni substation is done, and this line has been energized. And as I say, the 11 kV to the mine is also ready to be energized. That will indeed save us some money as we move forward with our construction program into the future. Just in conclusion, there are two slides. As Stuart said, we are 49% complete versus a plan of 50. We're 15 months into the program. We're very comfortable that we can make the other 50% within that 15 months. We're very comfortable we can accelerate with the right sort of support. And these two slides are really just for your information, and you're welcome to ask me any questions around them at the end of the presentation. So without anything further, I'll just hand over to Paul. Thank you.
Good morning, everyone. My job to keep everyone going until coffee time. So my job today is to give you an overview, before and after look with regards to our diamond resource and reserve at the Liquidbong mine. So just a sort of recap. So we're going to first look at the previous resource. Now that was put together quite a while ago, 6 years ago, 2009. There's two takeaways from this slide that I would like you to focus on. The one is that the previous resource was done at a bottom cutoff of 1 millimeters. Most of you that are familiar with the diamond industry know that the bottom cutoff has quite an effect on grade and revenue as you adjust that. And the other takeaway from this slide is that the previous 2009 estimate also included board diamonds in the estimate. So in summary, we had an indicated resource down to about 180 meters. There was an inferred resource down to about 500. Worth noting that the deepest hole drilled at Liquidbong is a 650-meter hole that terminated in kimberlite. So 100% sure that the kimberlite is obviously open at depth still. And then, just focus on these numbers. The gross number in 2009 at 1 mol was 29.6 million carats in the resource at a grade of 33, and that's undepleted. That's the full resource. All right, so the next one is looking at the previous revenue. Now, since 2009, there's been a number of revenue estimates. The latest one that you've seen would have been associated with the 2013 DFS release. We're lucky at Liquidbong that we have the pilot plant mining for close on 3 years. So we've got a fairly large parcel of diamonds to base our valuations on. Unfortunately, the pilot plant was not a very good plant. It was very prone to diamond breakage and losses. Just to give you an example of the over 1,000 plus 3-carat stones that we recovered over that period, about 34% of those stones showed some form of breakage, which is very significant. There was an interesting study conducted in the early part of 2013 where 9 large fragments, we're talking fragments of larger diamonds, and these fragments in themselves were 30 to 40 carats. We gave them to a diamond valuator just to get an idea of how big these diamonds could have been and how that would have affected the diamond price. And the conclusion was that 3 of those 9 diamonds were in excess of 200 carats. So for us, that is very exciting. And for me personally, as a geo background, that's what I want Glenn to build and finish, so we can start mining this deposit and see what we get. Getting back to the 2013 revenue estimate, so it was done at a 1 millimeter bottom cutoff, and there was a range of values released to the market between a base case of 107 and an upside case of 156. And that was really just playing around with the large stone potential. You guys would be aware that diamond revenue has essentially got two legs. It's about the size, the SFD, size frequency distribution, and the other part of the puzzle is the assortment, the quality of the diamonds. And by extrapolating those, one can determine an estimate of what the large stone potential of a particular population will be. And that's how that range was derived, from 107 to 156. All right, so that was the background to both the revenue and the resource. And now we're getting to our update now, 2015. That's a good question for why did you update? Well, a lot of things happened between 2009 and now. One being, Firestone obviously acquired the project. There was a lot of due diligence exercises associated with the acquisition and also with the finance. And there were a number of recommendations made in terms of how the resource can be improved. And one of the important ones had to do with the previous geological model. There were some discrepancies picked up. And before I even arrived, Firestone initiated a complete relogging of all the core. We're lucky at Liquid Bong, we still have all the core in pretty good shape in a core shed there on mine. So our geologists, over a fairly extended period, logged all it's about 10 kilometers of core, relogged all the core in detail. And I'm talking detail in terms of scan line, grain count. So our definition of the 4 different kimberlites that we have at Liquid Bong, we're confident on. As a result of the relogging, there was some shifting. So we still have the 4 different kimberlites, but a bit of shifting, internal boundary shifting. The significant change worth mentioning on the geological model is that previously the pipe at depth in the inferred portion was just modeled as a straight line. Now we now have experienced that in most cases the diamond pipes taper at depth. So this is how this one was modeled, and that had a result of decrease in volume and tons of around about 8%. Moving on to the next variable, which was changed. The previous estimate had a density, fairly low confidence density estimate. There was only one value per facies for the entire pipe. You may ask, well, what's the significance of density? Density is quite important when you go, your grade estimate is done in stones per cube. And to get to carats per 100 ton, you obviously need to know what the specific gravity is. So it's an important variable to understand. And as part of the relogging exercise, what we did is we took new measurements every 20 meter down competent core. And we got new data points, and that allowed us for the first time to do a proper local block estimate of density. The other important thing, which I touched on before, is the bottom cutoff. Now, since 2009, we obviously did the DFS, and the part of the DFS was all about the plant, optimizing the plant, and the optimization study showed that to start off, the 1.25 bottom cutoff would be most optimal for our plant. So everything needs to be adjusted to 1.25, both the grade, which obviously has a reduction then because you exclude some of the fines, but it has a positive influence on the dollar per carat. Then the other very important aspect that I touched on is the board factor, the inferior diamonds. Back in 2009, the guys didn't have the luxury of all the pilot plant information that we have now. All they had in terms of significant samples were some bulk samples that were collected at pit surface. And those bulk samples had high incidence of board, especially if you look at these factors, especially for K5. And at the time, they decided to include the board in the grade estimates. Now, in the benefit of hindsight, we've had all this mining by the pilot plant. Board came out only at about 3%, and given the fact that it's a nominal value, we decided to exclude it from this resource estimate. So that is a significant change, and that obviously affected the grade and the carats. So coming to the dollar per carat, obviously the one thing that I want you to understand, this is obviously a sequential process. So we didn't go out and say we just need to do the geological model, and by the way, let's do the resource update. The plan was to do what we're doing right here now, to give you a business model update. It took longer than we initially expected, but it was we planned a sequential process of updating the geological model, the resource, the revenue, the mine plan, and then, the business model and being able to share that with the market. So at some stage, we had to go out for a new revenue estimate to hand that over to the mine planning process. Our revenue estimate was the one we used in this model update was done in August 2014. So we started off with a base value, a repricing of our typical parcel, and that had to be adjusted then for the 1.25 cutoff. And then what we also did, similar to the previous exercise, we also looked at the large stone potential, the extrapolation of the SFD and assortments. And because we have an SFD for each facet, but only one assortment model, so that enables us to get, for the mine planning process, we then have an average base US dollar per carat per facet. Now, if you plug that into the mine plan, and you'll see that later when you look at grant slides, that gives us over the life of mine, unescalated, that gives us 131 as a value for Liquibang as we stand at the moment. Given the current, since this valuation, obviously the market's gone a bit soft, and we thought, in terms of our modeling, instead of escalating from that period, we just kept these pricings flat until we get into production early 2017. So to be clear, our assumption so what we're assuming at the moment is that the price we got in August 2014 would be the same as we're going to get in January 2017. That's basically our price assumption at the moment. All right, and then finally, we obviously had to remove from the model what we've mined out so far. So we had to adjust for depletions of the pilot plant, and that then gave us our final model. So in summary, the net effect of all these changes I just took you through is that we had a volume and a ton change of around about 8% reduction. We had a carat change of 22%, and that's a result of the bottom cutoff, and of course also the board removal. But the dollar per ton in the ground has increased. And coincidentally, the overall in situ resource dollar value in the ground is almost exactly the same. I think it's 0.3% difference at around about US $3 billion. All right, and that's the official compliant diamond resource statement, which you'll see in the releases. So at the moment, we've got it indicated down to 180, similar to the previous statement, and then in inferred to around about 500, and the total diamond resource 23 million carats at a grade of 28 CPHT. All right, so that was the resource story. I hope that made sense. And now we're going to move on to the next step in the process, which was obviously then, after we've completed this, we could hand this over to the mine planning guys to update our mine plan, or to derive a new mine plan. But again, we just have to look back in terms of what the previous mine plan looked like. It was a 2012 edition. It was a concentric pit. There was an update in 2013, you would recall, a slight adjustment to the overall tons over life of mine. That was really as a result of removing the pilot plant production. We closed the pilot plant at the end of 2013. And obviously the indicated portion of the mine plan, which is the probable reserve, at that time was around 11.4 million carats at a grade of 31. So moving on to our new mine plan, as I said, the resource work after completion, we got the block model, and we got our revenues, so they were ready to start the mine planning process. All started with the whittle pit optimizations to determine our optimal size of our life of mine pit. And on the mine design side, it took a little bit longer than we thought, because we started with a concentric, vanilla type mine design, 10-meter benches, 20-meter double bench for the final cut. But then we decided to also do split shell mine design, and the next slide I'll explain the fundamental difference between the two. We had two split shell mine designs. The first one, again, at the same bench configuration, and the third one was done at 40-meter bench and 28-meter double bench. You'll say, well, where does that come from? Well, that comes from our neighbor. So we visited, I was there as well, visited Letsing, and they just recently signed off this bench configuration for their two pits. So we're very lucky that we have Letsing very close to us. I mean, they've been going for more than 10 years. They've got two big pits. They're mining split shell, and they're using this bench configuration signed off by SRK. And we had SRK check our mine design, and they were also quite happy with ours. The little picture you see at the bottom there is just a concentric. I'm not going to read through all these bullets, it's for your reference. We obviously have to go through a pros and cons analysis of which mine design works best for us. As I said, we selected the split shell. Essentially what a split shell is, the difference between that and a concentric is that you only mine one half of the pit. You mine the one half of the waste first, and then you shift to the other side. And the advantage of a split shell is you defer. You manage to defer waste in the early years, which of course is what you want, advantageous for the cash flow. Split shells has been in operation for a number of years now. Venetian mine at De Beers, I worked at. In fact, the mine planner, ex-De Beers mine planner, he did our split shell design. As I said, Letseng is using exactly the same method in very similar geological environments, so we're quite confident that our design is going to work and we're signed off. So if one looks at the waste profile between the concentric and the split shell, you'll see the split shell being the blue. In the early years, we definitely save on the waste. And what we're also able to do with the split shell, you defer the peak, the 2 years of peak waste, you defer by 2 years. And that's all positive for cash flow. This is what it looks like in section. One thing to maybe, Glenn showed you a number of pictures to get a feel for the sort of lay of the ground. You'll see this is the actual slope surface. You'll see, it's a challenging environment. We're not in a flat area. We're in a very mountainous area. The pipe, in fact, is in a valley. So as you strip, there's a lot of unnecessary material that you need to take out because it's not flat. What you see over here, we've got a cut one. Now, the nice thing about this design, what I like about it, is that cut one is a small concentric pit. So the first 3 years is going to be sort of high confidence from our side, mining a small concentric pit at a strip ratio of only 0.5 before we actually start with a split shell configuration. So it's concentric cut one for about just over 3 years, and then we go cut 2 south, cut 2 north, and then cut 3 south, cut 3 north. So in overall, the mine plan, we're recovering about 52 million tons of ore. The waste is 105 with a strip ratio, overall life of mine strip ratio of 2, and recovering just over 40 million carats. Just another picture summarizing that same split shell design. So you can see, as we ramp up year one, the carat profile goes up. We average around about 1 million carats per annum, and you can also see the waste tons profile, which you've seen before. And then we stabilize in terms of the plant capacity around about 3.6 million tons per annum. All right, this is a variant summary. Again, you're not going to read through all of this, but the takeaway, this is now comparing the new mine plan against the 2013 DFS. Now, the last one that went out to the market. You'll see we managed to reduce the overall waste tons, which is quite nice. Stripping ratio reduction. Ore tons more or less the same, but of course we got a knock on the grade and the carats as a result of the resource, as I explained to you. Overall life of mine revenue is up by about 13%. Those are the escalated values. And as I said, we only start escalating our revenue estimate at the beginning of 2017. You'll see that again in Grant's slides. And then thanks to the beneficial dollar-rand exchange rate, overall revenue compared between the two mine plans in rand terms is actually better. All right, here's the official diamonds reserve statement. Again, you will see that in the press release. So the indicated portion of our mine plan, our reserve is now standing at 9.5 million tons at a grade of 26. And that, of course, is applying the modifying factors. We've got a dilution factor, which is included here, as it should be. And so the overall life of mine plan as it stands now is just over 53 million tons, and we're recovering just over 14 million carats. And that's everything from my side. I'll gladly take questions at the end.
Schedule for a coffee break now, so we can work it all up. 6 to 10 minutes, please, and then we get back in, and then we just end with the finance and the markets, and then we can jump into the questions. Thanks very much.
Good. Well, I hope everyone's sufficiently refreshed. My slides won't take all that long to work through. Unfortunately, I haven't got any pretty pictures to show you. Just some solid numbers. So let's get into it. Glenn's obviously given you an update on the project, and Paul's given you an update on the resource and on the mine plan.
And there's been a lot of information that's been presented. And two questions, I suppose, come to mind that need to be answered now. The first one is, what is the impact of all of this information on our NPV, on our project NPV? And the other question is on the project. You know, where are we currently? How much have we spent? How much do we still have to spend? And how is that additional spend going to be funded? So just to take you back in time, you'll recall that we went out in October 2012 with a DFS that produced a net present value at 8% discount rates of 335 million. We then updated that DFS in November 2013 and got a result, an increase in NPV up to 379 million. A couple of items that were included in that update were with a change in the dollar per carat. FX rates have been adjusted to a consensus rate of 10 Rand per dollar, and that was held flat all the way through. And the CapEx number had also been adjusted. Previously, it only included a portion of the capital on the power line, and that was adjusted to cater for 100% of that capital requirement. Since then, obviously, things have moved on. We've now got our new diamond resource and diamond reserve updates. We have a new mine plan. We have new revenue per carats that have been calculated, and we've rerun all of the information that we've received through a new financial model, which now is it's been calculated on a zero-based budget principle, and it includes the impact of funding, which the previous model didn't. So you can see here that our initial capital for the project has actually increased from 1.8 billion up to 2 billion rand. Our exchange rates, which previously we used a rate of 10 to the dollar, we've now used a consensus rate of 13.27, which is somewhat lower than today's current trading price. I think it's trading at about 13.70 at the moment. The result of all of this is an increase in NPV to 389 million, an increase in IRR to 42%, and a 7-month shorter payback period of 49 months. Okay, so the NPV has obviously been impacted by a number of factors. First of all, we've got costs that have been calculated in today's terms. We've then got the impact of the new resource, the revised carat profile, and mine plan. We've got very slight increases in operating costs and capital, and all of those have been offset by tax and by FX gains, which take the NPV on an ungeared basis up to $369 million. Adding gearing to that, so adding the effect of financing, gives us a further benefit of $20 million, taking the geared NPV up to $389 million. Now, obviously, the model's been recalculated on a number of assumptions. There's a lot of data in the slide, which I'm not going to go through in too much detail, but I think it provides everyone with sufficient information to update their own models. A couple of items that I'd like to touch on, however, is the average strip ratio, which was previously 2.3. As Paul explained in his presentation earlier, due to the mining methods that we're going to be adopting, that drops to 2 times. We've then got annual average production at 1 million carats. We've got an operating cost per tonne processed in dollar terms that's decreased to $14.50. And we have our project capital in dollar terms. I'll take you through some more detail on that in a moment. Although it has increased in rand terms, it's actually stayed at the same in dollar terms, and we'll be producing through this new model just over 14 million carats. At this stage, it's just important to mention that the price that's being used in the model, you'll see that we previously had an average dollar per carat of 146. We now have 165, and that is based on a 2014 price that's been kept flat right until we start producing at the end of Q4 in 2016. In fact, the escalation that's been applied here only commences from January 2017. Okay, sensitivities. The project is clearly highly sensitive to two particular items, or to two specific items, being revenue and foreign exchange. From the spider graph, it shows that quite clearly as well. The revenue is an interesting one. For every 5% change in the revenue number, there's about a 10% impact to NPV. And for every 5% change in the foreign currency exchange movement, there's about a 5% movement on NPV. The FX rates that we've used, we've adopted this consensus rate of 13.27 in the model. And as you can see in that graph at the bottom right-hand side, the rand has been exceptionally volatile. If we have a look, it's gone from a rate of just over 10 to the US dollar in November 2013, over there, all the way up to, in fact, it hit over 14 to the US dollar in August of this year. And the forward curve, which we've added onto the graph here, just gives you an indication of the economic outlook weighing in against the rand. So I think from our perspective, we feel that the number that we've used of 13.27, the consensus rate that we've included, is probably fairly conservative given the outlook. Production and revenue. This slide, or this part of the model, incorporates a lot of the work that was done by Paul and his team, and it's really a culmination of over a year's worth of work, very, very detailed work that's been done, carried out by Paul and his team over the year. We've obviously plotted here the clean ore versus the waste tons, and you can see very, very clearly from this that we hit quite high stripping rates from about year 5 through to year 10, and the peak stripping rate goes as high as about 5 times. But on average, we'll achieve a strip ratio of 2, which is favorable to the previous model, as I said earlier, 2.3. Furthermore, what we've modeled is 14 million carats at an average price of 165, which will yield just over $2.3 billion worth of revenue over the life of the project. Operating costs for the project have, although they've increased in rand terms, they've actually decreased in dollar terms, obviously by applying the FX rate that we've applied. The costs that we have included on the slide have been built up from zero-based principles. We've got various managers in charge of each of the disciplines, so we've interrogated all of those numbers. We've challenged all of those numbers with the individual discipline leads of mining, processing, engineering, energy, and we're fairly comfortable that those costs have been adequately justified. We're obviously still some way from ramping up to production, and certain of the key contracts are yet to be negotiated. But where we have made estimates, those estimates have been made using other mines for benchmarking purposes. Just to give you an indication, the cost per ton processed that Letseng is paying at the moment is around 210. So at 192, we feel that being a smaller operation, Letseng have 2 plants. Letseng they've got 2 pits that they're mining, and they're mining certainly at far deeper levels than what we will be initially. That the costs are probably fairly conservative at this stage. Now on to the second question around capital costs and around our funding. You see that we started off with an original budget of 1.854 billion, and that included the main plant of 1.7 billion and the power lines for 150 million. Since then, obviously, a lot's changed. Glenn took you through or mentioned some of the challenges that the project faced certainly early on, and it resulted in an increase in costs of 156 million for additional overburden and adverse weather delays. But what we've also done is we've tried to de-risk the project as much as possible, and there's certain streams that we're looking at bringing online earlier. These come at additional costs, so we've got some operational readiness that we've included in our capex cost now. We have had a saving on the power line project. As you all know, it's been announced that Storm Mountain share that line with us, so they contributed 50% towards the capital costs of that, realising a saving for ourselves. And that's helped, together with the FX, that's helped us to keep all of these costs within the original budget of $185 million. The other risk mitigation item that we've included is a tailings conveyor system, which was previously funded through operating costs that were going to be paid during the life of the mine. And we've now taken that out, and we've decided to fund that through the project capital. So, where are we funding the project out of? Well, you'll recall that last year, and Stuart opened with this in his statement, that we managed to put together a financing package to the amount of 225 million last year, and that excludes the standby facility of a further 15 million, taking the total project funding, including the standby facility, right up to 240 million. On the right-hand side, you can see that at the end of August, we had 114 million worth of cash and debt facilities available to the group, 21.6 million cash in the bank, a remaining 10 million from the Eurobond facility. We drew down 20 million against that facility during August, and the ABSA project facility of 82.4 million, which we still had full access to that at the end of August, and we drew down 7.6 million against that facility in September. So including the standby facility, we have total funding available to the group of 129 million. And going forward, our forecast expenditure is going to come to 110.4 million. In terms of the risk items, the risk in this is really isolated to the project capital line. You know, all of the others, financing fees, these are pretty much locked in. We know what those are going to be. Group working costs aren't going to change substantially. The conveyor system has already been priced. So really, that's where our risk lies going forward. And at this stage, we're sure that that as long as we don't experience any significant further delays, that we will be able to bring this project in on the dollar budget of 185 million. So I suppose just to summarise, I'm afraid I haven't got a summary slide for you either, but just to summarise, we've got a new NPV of 389 million. We've got an increased IRR, which is now 42%. And we're obviously very pleased that the project remains within the original capital budget of 185 million, and we'll try to make sure that it does so going forward. Thank you.
Thanks, Grant, and thanks, team. What would be good to touch on now is just spend a few minutes talking about the market, and before I've got two placeholder slides to talk to you about that. Obviously, if we go back in time to the production world prior to the crisis, so prior to the 2008 and 2009, the world was happily going along, and in those days I was a big part of De Beers, and we were sort of aiming for 50 million carats a year production, and every year we had to beat last year's production. So the only way you really do that in advanced and aging mines is to change your bottom cut-off sieve size. As Paul will know, at Venetia we did that, and we created a huge amount of fine diamonds that we unlocked, which can also jam up your plant. But nevertheless, we used to produce as a massive industry about 170 to 160 million carats a year that used to get pushed into the market at great pace. And what really unlocked the small size fraction diamonds was the Swiss watch industry. About 10 years ago, and slightly longer, it started putting diamonds in watches. If you go back 15 years, you very rarely saw a watch bearing lots of diamonds. And as that the fashion industry and the high-end marketing has got that ball rolling, you've seen more and more of the brands, the Chopards, even Rolex have sort of departed from their real traditional base and really put a lot in. Then you've got the Tag Heuer brands, the Hublots, and all of those watches coming through and pushing that in. And that really absorbed that. When we approached the crisis in 2008, there was a distinct belief in the world that didn't really apply to diamonds, because the very, very, very wealthy, high net worth individuals of the world, the oligarchs, would continue buying $10 million stones as if nothing had happened. And what happened in reality is the diamond pricing effect in the market just fell off a cliff. Towards the end of De Beers' life at 2008, sales just disappeared. From an average of about $700 million every 5 weeks, it dropped to below $100 million. And that was a fundamental mind shift in the way the production world looked at. And I think that is the core difference between the diamond industry and every other commodity industry. So while you're mining diamonds, and I think you may have heard me say this before, it's a commodity. It's cost per ton. It's don't kill people. It's get your tons right, the right tons, the right cost, your plant efficiencies. That's how you run your mine. The minute that that product hits your salt house, and you counted it and you know how much you've got there, it's a luxury good. It doesn't need to get tainted by conflict, by political infighting to use it to fund things and source funding for conflict. That is a very damaging process. So the industry itself reacted to that, and as the Minister is very familiar with, we've got the Kimberley process, which is all designed about making sure that countries subscribe to this. This is not a De Beers industry-driven project. It is a country united front of protecting the value of the assets that the diamond-producing countries have that's in the ground, because those, like in Lesotho, this is a key part of their future economy. So we can have nothing damaging that. And this industry has got the supply-demand balance right. And I think in the announcement you'll see me write, and probably quite confidently about it. I'm glad I'm in this industry. We're in an industry where demand is growing, and it will continue to grow. Even though China has slowed down, it hasn't slowed down to such an extent where it's stalled. The US is still a strong market, traditional market. And you've seen, post the crisis, you've seen enormous price growth in the 2010, latter part of 2009 and 10, and I'll touch on that in a minute. But you haven't seen production grow through the roof, back to pre-crisis levels. And that's because this industry actually recognizes the long-term value of keeping your diamonds in two places. You either keep them in the ground, because that's the best place to store them, or you mine them at a rate that you can sell them at that price that you need to make your profit. This isn't a Rio Tinto with Sam got a really low cost and he's just put his foot on the accelerator and he's going to pump iron ore out and he's going to blow everyone out the water, which is what he says he's not doing, but he's giving a good impression of doing it at the moment. You're not seeing De Beers or Alrosa pump production up. In fact, they're doing the opposite, which tends to sometimes get them that unwanted attention of the EU for being a competitive cartel and all of those words that they use around it. So I'm seeing long-term trends of about 120 to 130 million carats a year. If you take 2014, you don't see much growth, and in 2015, in fact, you're going to see a decrease in production as De Beers has guided you down twice during the year. Alrosa has been very responsible. They haven't pumped a lot of goods on the market. There's no doubt in my mind that the big powerhouse that drives the industry, which is De Beers, got it wrong towards the end of 2014. And I think if you talk to them privately, as it's a great company to talk to privately, they will admit that quietly. Publicly, they will say that the market is difficult and there's a lot of other players that need to come to the party. But we saw a big push of production going onto the market in the rough market, and we saw a big push in price in 2014, far longer than we should have seen, in anticipation the 2014 selling season would be very good. The resultant US market wasn't bad at all, but China had slowed down, and it had probably come down from double-digit growth to about 6 or 7% growth in the retail space. That would be fantastic in any other country in the world, in any other diamond market. So let's not get depressed about it, but it had the effect of pushing too many goods on the market towards the end of 2014. And when we opened up in 2015, the jewelry stores were still full, thank you very much. The polished prices and the polished producers and the polished wholesalers and the polished market had sufficient stock. So you've seen a convergence of events in 2015. You see, Antwerp Diamond Bank announced they were pulling out. They couldn't find a buyer for the bank, and they were a focused lender to the diamond industry of about $1 billion of debt a year, funding site holders and various other diamanteurs, and they were going to wind their business down. So you saw this panic about who's going to fund the diamond industry, who's going to buy these goods, and where they're going to get debt funding from. You then saw pressure on prices, a marginal decrease by De Beers, and I'll again touch on De Beers versus the rest of the world in a minute. And 2015, no doubt, has been difficult, and I think De Beers have been a bit slow to recognize that, but they've now come to the party, and I think fundamentally the drivers of this business have recognized that we don't want to push more goods out there, so you will see declining production. And then you say, well, hang on, Likhaavong's coming onto production, you've got Gachakwe coming onto production, you've got the new 2 mines in Russia, you've got Stornoway, and let's add all that up, and that's another 10 million carats. So let's add that to the 130. Now you're at 140, but you're getting back to the 160. But you're also seeing a declining population of older, aged mines up in Russia that are reducing their production. You're seeing, you know, the old deeper mines in South Africa, the Cullens of this world, having to spend a lot of money going a lot deeper, and their production overall, while they're increasing it, the aging mines are actually reducing over time. So I think we're staying in balance there. You're not seeing a lot of new discoveries on the horizon. The exploration dollars have dried up dramatically. So we certainly feel that the long-term fundamentals in an industry where supply hasn't got the capability to drive itself well ahead of demand is something I'd far rather be in than one where your demand can be met by supply very easily, and we've seen lots of big iron ore projects come on in recent years. So if we take overall price growth and you say, well, why are you using 3%? And if you look at all of our competitors and our peers, they range from 1.5% to 3.5%. And you look at the historical compound annual growth rates over time, and you take diamonds over the last 40 years, it's not a sexy price growth trend to look at. It's fairly mundane. It plods along. It has the odd crisis, but it always tends to go up. And that's because, and we're in the room now, supply is well regulated and the market is well understood. And I think 2014 was maybe a year where people got it wrong. You don't always get it right. And 15 has been a year of correction. I think that's going to follow on through 2016. And fortunately or unfortunately, depending on your view of life, we're not going to be participating in that. Hence our conservative outlook for diamond price in our own model, and thinking to ourselves, well, we will come to the market late in 2016 and early 2017. And there's, you know, no doubt, talking to my fellow colleagues out in the industry, there's a view that we really have a marketing plan. There's a view that we can't let this $80 billion retail industry just flounder out there. De Beers is once again taking the lead to try and remedy this. It's moved production down. I know it's pumping extra money into marketing. The World Luxury Good Index, if you take handbags and take all other luxury products, it's still selling very well. So it's not that the world has decided not to buy the luxury goods. You've got to fight for your space in there. We call it fight for the share of the wallet. So if a wallet's walking around the high street and it's got £10,000 in it, it's going to spend it somewhere. Your job is to get it out of the leather goods store into the jewelry store. Your job as an overall diamond industry is not to get out of Tiffany's into Chanel or out of Chanel into Hermes, because it's all going to be in the diamond fashion. You've got to get it out of the Louis Vuitton leather section and the handbag section or the Birkin bag section. You've got to get it into the retail store to buy more diamonds, and that'll drive growth. China's phenomenal growth in 29, 10, 11, and 12, as it were, was a really stocking of all the retail stores. And now it's probably more normalized in a way that it's got to drive its retail growth. There's no doubt that the world's population is urbanizing, that everyone's getting wealthier. There's still these big perceptions of, or real gaps between the wealthy and the poor, but that doesn't stop people being aspirant and wanting to buy all the luxury goods. So I think fundamentally we're in a business that is in the right space. It's got responsible leaders. We're not all pushing production to try and out-muscle each other as big producers. And the little guys, like we are at the moment, we're sort of the fighting fit. We don't have a lot of baggage. We're a niche player. We can move our products around to where the market is best placed to give us the best price. And if I do then come to that, you see De Beers leads. Everyone still tracks their pricing of De Beers. I think De Beers started in January, 3% drop. And having worked through a crisis before in De Beers, I think that to me was their first mistake. If you open a box and look at it and look at the value in there, and you were paying $100 last month for it, and now someone gives you the same box and you say, well, it's 97, you don't see 97. It's not a mental thing. You think $3 a carat I've lost here or whatever. I don't know. It looks the same to me. If you open that box and see it's only 90, I'll tell you 10% makes a big difference. You walk out of there, I paid 90 cents in the dollar for this. Last month I paid 100 cents in the dollar. Gives you a better sense of confidence. I think De Beers now they moved their price down, and they've done it 3 times this year. I think there's a feeling in the market that there's a punishment, and our data tells us, we talk to the general market a lot. We've got a lot of influential people that sell diamonds, and you've seen all the talk in De Beers. Their sites have been really low. The site holders have rejected goods and not buying at those prices. De Beers is fundamentally charging too much, and any site hold, having met them though for many years, never tells you, gee, now I got a bargain last week from De Beers. All they say is I paid too much for it, whether they're making money or they're not making money. It's just not in their DNA to ever say, I made a lot of money last year. Have decided to not buy and are pushing really hard, and I think De Beers is resolving that relationship and doing it fairly well. The secondary market is still doing very well. Our diamond expert that we use sells about 3.5 million carats of high-value diamonds in Southern Africa, Angola, and Europe. And he says, in his view, he's seeing quite competitive pricing in terms of the high-end, higher qualities and higher luxury goods. Indeed, you'd see GEM doing their prices. So when Letseng produce their high-value stones, they're not seeing 15% drops in the higher qualities and the crystals and the 2s to 3s and 4s to 5 and 6 carat stones up. So fundamentally, we believe our diamond price that we put together, that Paul's there. I know one of the questions that we'll address now before you even get to it is, yeah, but you got a price in 2014, so in August, why didn't you update it for 2015? And as Paul said, it was all part of a process. We've got to draw a line in the sand at some stage. But we have monitored the market closely, and we see in certain areas, especially in the lower qualities, we've seen price definitely under a lot of pressure. But in the mid to high-end qualities, there's a lot fewer of those carats around the world. We're seeing those prices pretty robust and pretty stable. So when we run our quick pricing model on that, we think our $131 average or the $132 in the reserve is the right price for us, and we believe that's being conservative around that. We're not pushing the large stone angle. We haven't spent any time really trying to calculate that, but we're seeing healthy movement in those. If you see the auctions, you're seeing stone sold for $19 million. $20 million. Lucara has done set records, has large stone auctions. GEM doing large stones as well. So I think the industry is healthy, but like all things, you can't have a global crisis going on in terms of the mining sector as it is in the bulks and have the carnage out there with your share price coming from £5 down to £1 and not be affected by that, because most of you sitting in this room, believe it or not, are the consumers of the product that we're busy mining. In that's the target market for the higher end. So everyone's naturally cautious around that. So I personally believe we're in the right industry. I've never been more confident in this because it's in a crisis, and we've been through these before as an industry. We know nothing could have got worse than 2008 and 2009. Trust me on that. It was, really, really high learning levels. And at Firestone, we have not put a huge overhead to try and have a luxury lifestyle around this. It's to recognize that we've got a big part to play in the government's vision of being successful, and the government have a big part to play in our vision of being successful. So we're joined at the hip with government. We've got a product that we've got to maintain the integrity of. We've got the support of government doing that. And I think as an industry as a whole, I think the fundamentals are right on that. So I think 2015, you'll see people reporting their results. Yeah, you're not going to see fantastic results, I think, in terms of certain areas. There's certainly been a realization of cut costs back. In 2016, I think you'll see consolidation, and provided the world solves a lot of its other problems, I think we'll see tendency towards the end of that of recovery because of the actions taken. And when we come to market in the latter part of next year, I think we should hopefully get the timing right in life. But a lot can happen between now and then. Thanks very much. I'll hand over to Lucio to give us a summary.
Thanks. So, Honourable Minister of Mines, Totanyane, thank you. Mr. Commissioner as well, thank you very much for coming here today. I think they've travelled all the way from Lesotho to be here today. Ladies and gentlemen, also thank you for coming. A lot of information has been presented to you, and a lot of work has gone into this information preparation. I hope it's been useful and helpful, and it clearly shows how good the Likabon project is and how transformational the Likabon project will be for Firestone Diamonds and the government of Lesotho, which was our 25% shareholder at the project level. I'd like to leave you with two things to take away today. First of all, our team. We have a very strong team led by Stuart Brown, and he's supported by a ExCo team, which, as Glenn said, has over 120 years worth of experience in diamonds. This team has been working extremely well, and I've witnessed it in that there's tremendous communication, effectiveness in collaborating, particularly in situations of difficulty. When we had the problems with the overburden or we were faced with torrential rain in November, they sat down, worked out a plan, tried to maximize the use of their resources and try and minimize the damage because of the circumstances. So this has been very good to see. Secondly, I think the footprint of the mine is very small. I mean, once you get up there, you'll see we have 600 people, working there every day, and it's a lot of coordination, a lot of people running around, especially with the earthworks, big trucks, and that we have an impeccable safety record. I think that's very commendable, and of course we'll continue to maintain that. In August, we made this a board trip to the mine, and I've been involved in this project for some years, and we had our little pilot plant in 2011 and 2012, and it was truly impressive to see the dramatic changes that had taken place over the last 12 months. So a tremendous amount of work has taken place during this period, and I would say one thing that impressed me the most was actually looking at the people. There's a tremendous positive drive, positive momentum by the people. Everybody is busy. Everybody understands the urgency of getting things done. So I think that was very impressive, whether it's the subcontractor, the contractor, our owners team. There's a lot of excitement to make a change, really make a change, and to do it within the time. So I think that was very impressive for the board to see during our visit. Onto the project. As I said, a tremendous amount of work has been done into this, into revising the resource and reserve. We have a new mine plan. We have done work on operational readiness, and what is clear is we have a robust project. We have a robust project based on the base case, and hopefully we can deliver a truly exceptional project if we can deliver on the upside case going forward. So that's what I wanted to say. Thank you once again. I'd like to also say one more point. The difference between what I see, and I come across various commodities, whether it's iron ore, copper, or diamonds. In the diamond space, as Stuart alluded to, there's a lot of responsibility by the major players. They understand that it's very difficult, if not impossible, to annihilate your competitor. It just simply doesn't work. You're playing against governments, you're playing against currencies, you're playing against financial markets that will sooner or later develop various projects. And so it's very difficult to do that. And so the responsibility of De Beers and followed by Alrosa in a quiet way is very effective for a small player like us. And secondly, I would say that the diamond market is not only China-centric. China is important, and of course it's a growing market, and followed by India. But the United States plays still a very big consumer market, and so, you know, being in the space does make a difference vis-a-vis whether you're in the iron ore or copper business. So we are very excited. We have a strong project. We have a strong team. We are working extensively with the new government. The government is a new government and has taken over from a coalition which didn't really work. This is a large coalition of 7 parties. They've taken some time to get their understanding of what they need to do. They've made a lot of promises to the people. The environment in Lesotho is not very easy. There's a lot of unemployment. We have made a special effort to work with government to show them what we want to do, how we want to work, what our intentions are. They obviously have made promises to their people to get elected, and so that's why we felt it important for the minister and the commissioner to come here today to understand, to meet the investors, to see exactly, what we are committing to our investors, so that you understand what we need and how we need to work together with you. So I think that's very important, that we work closely with government. We understand their needs. They understand our needs. They understand we have a time constraint. We have a cash constraint. They have a social community obligation. They have an obligation to their voters. The environment is difficult. Let's not face it. There are challenges ahead and there are risks. But I'm confident that with this team and with our collaboration with the government and all the various stakeholders involved, that we'll be able to deliver a solid project come towards the end of 2016. Thank you.
There's time now for questions and answers. What the questions are, and I'll then either field them or direct them to the person most qualified or best qualified to answer. Yes, Brock.
2 questions. Firstly, on the large stone prices. We don't have an update today, but if we step away from the diamond prices, ups and downs, we had $49 a carat before for large stone. Has anything changed in your studies that would, other than diamond prices and macro, which would change that assumption?
I can answer that first of all. So the question is, have any of our assumptions on the diamond price or the diamond large stone population changed? I think the answer is a solid no, Paul. We just, it's a very speculative market. Why do you price them? So we've gone up to the 100 carats, from 10.8 to the 100 carats in our estimations and values, but we haven't sort of updated that with the latest pricing. We just think that's not our focus at the moment. We just want to give the base and deliver that. That's our guarantee, as it were. So no.
One more question. It strikes me that the tricky part of the mine build was the civils and getting the layout done, and you've obviously had those delays. Is it fair to say you're on the home stretch now, you've got that? I mean, what are your biggest challenges ahead? And if I could sort of ask both the operational guys, Glenn and Paul, as well as Stuart, if I could ask you to reflect on that on a sort of organisational basis as well.
Yeah. So the question basically is we're 50% through the project. We've now moved into the construction mode, and what are our risks and challenges? I think Glenn and Paul need to answer that. They're the guys dealing with it.
Yeah, as I mentioned in the presentation, from an earthworks perspective, we're almost through it. There's no big challenges there. Really, it's getting the work permits for the civil so we can accelerate away and ensure that we've got access for the SMPP and the electrical and instrumentation contractors. We don't see any problem in productivity rates, in build rates, in access to site for equipment or steel work or anything like that. It's all being very well managed. So we don't have, I don't see from a build perspective that we have anything different, apart from having to drive 8 hours from Johannesburg, than we would have driving 5 hours to Botswana or 3 hours to the Free State or one of the De Beers mines. No real issues there. Nothing that worries me anyway.
While we've got the Honourable Minister in the room, if perhaps I could sort of ask the question how the government stands, and you mentioned on sort of getting all your staff on site. Are you comfortable now that you've got all the processes in place to support Firestone?
Yes, we do. Yes, we do believe that we have got all the processes in place to support Firestone. And I think the biggest thing coming from is around the issue of ensure that we find the balance between discussion that we've had, and we are waiting on that solution. Our ministry has taken a lead to make sure that Firestone investment actually can facilitate it whatever way possible to make sure that their timeline.
I think if I could just conclude on that, I mean, the Minister, it's certainly been an education process for both parties to understand that. And we've always understood the government's challenge and the country's challenge about labour and skills transfer and development. But I think we've got the mining ministry there, they're leading the charge, it's getting the rest of the country to buy in. But we're in the, as you said, Brock, we're the 12-month, let's call it the 15-month home stretch. And there's a healthy challenge between we can get this done very quickly. We want to build the operational side of the mine. That's where we've given our strong commitment to meet the quite aggressive targets of localization and citizenship transfer. We don't have a problem with that, and we've bought into that. But obviously Glenn's critical role is, these contracts are fixed-term contracts. We don't want to spend any longer doing it, and construction and operation are two different things. I think we're pushing that message through the other ministries to make sure that there's buy-in and that support. That's probably the biggest part of my role, and the main contractors and Glenn's role. When you start these projects, you always think that's what I'll be doing and that's what he'll be doing, and then you actually get to doing them and you discover that you have to, use all those skills you thought you wouldn't need in other projects. But that's why we've got this broad base of doing that. So I think the Minister summed it up very correctly.
So we're just following on from that.
Yep.
If I may, the operational skill set, is it there? Are you training now? Are you having to plan that in for local employment this year?
We've got Mark, so the question is, what is the operational readiness effectively? We've identified some of the core skills that we need and people that we need. We're not, as we said earlier, I think we're not looking at Letseng or Kao to say we'll take their production manager and their mine manager. That's not going to be good for the country at all, because that doesn't add to the base. We've gone out and looked internationally for Basutus that are working elsewhere. We've identified a couple of people already that we're talking to bring them back, as it were, to the country to do that. So we've identified a plant manager. We think we've got a security manager, but we need to, get these people back in country. And then the operational readiness is all about looking to see what's out there, and that'll happen from July next year onwards. We're looking at that's when we're ready to do that as we ramp up towards production. So that's why we put that extra money in the budget to do that over that time. So we're going to go Nick, and then I'll get over there.
Hi. You're targeting Q4 next year for first production, and then there's a sort of ramp up across 2017. At what point do you envisage the project going cash flow positive at an operational level? And does the revised CapEx budget take account for working capital throughout that initial period?
Yes, it does. I think so. The question on that, I'll let Grant answer those things. But what we have, why we say Q4 and not 31 December is, you saw Glenn talk about, the October is our internal date, and as we're managing the market, we think we've costed to December. And there, but Grant, maybe you want to elaborate on how you've built that and how tight things get.
Yeah, we've, as you can see from the available headroom at the end of the project, you can see that without the standby facility, the cash does run fairly tight. That does get us into early production, and things are going to be tight for those first few months. But I think once we're through sort of the first 5 to 6 months of ramp up, and we've got the revenue coming through, then we should be fine. It's really the first couple of months of operating that are going to be tight for us from a cash flow perspective.
I also think, Grant, we've been conservative in certain views. We've got other options around strings you can pull, moving cash around there. So that's Grant's core role. He has sort of one KPI from my side, and that's don't dare run out of money. And that's kind of what we do. And I think if we go back to prior to raising the funds, from about 6 months to go, from having done our term sheet and getting the commitment and actually getting the money, we had $1 million. And every month I said, well, how much money we got left? You go, we've got $1 million. I'd ask him the next month, we still got $1 million. How are you doing? Where's it all coming from? But so it's very careful with management, supplier management, and all of that. So I think we've got that headroom to move it around. And we even consider we haven't put any early revenue in. So all the spare tons that we've got that we're going to put through in the commissioning phase, there will be. We haven't put that in our budget as well. But it does get tight. It's a good observation.
But it's also important just to mention that the cash flow that we've projected is all on the basis of 13.27 to the dollar.
Do you have any protection on the flip side of that? The rand to strengthen again?
The rand to strengthen. Yeah, well, as a company, we've got a hedging policy. And it was actually one of the criteria of our ABSA debt facility that we hedged at least 50% of the project capital, which we did. But we've now got quite a bit of exposure. We're exposed to about $60 million worth of the project's costs going forward, and we'll continue to adopt the hedging policy that the company has in place.
You had a question there, Martin.
I just have a quick one. That base case. US dollars per carat, the energy prices, that's still excluding large stone, correct?
Paul, do you want to take that? The large stone question on the base case number of the 131.
Yeah, are we looking at the same sort of split that we've done back in 2013?
Yes, the answer is yes. So what we've done, we did factor in, or we did model in, a large stone potential up to 100 carats on the same basis as the base case in 2013.
Okay, so the 107 starting number in the base case then is directly comparable to the
131. Yes.
Just the from 1 mil to 1.5.
Correct, and then also the base price obviously changing in terms of when it was valued, and then how it was applied. You can see the difference there in terms of the 13% in terms of escalated value.
Okay, so there is still large diamond upside
on top of that.
Correct.
Yes.
Okay. Second thing, I think you said that you were escalating to 3% more from 2017.
Yeah.
Right.
And we've done that on a monthly basis. So it's not 3% 1 January. We've factored that 3% over. So it's at the end of 2017, you would have seen 3% growth. That's how the model's built. We kept that consistent because it was in the original, because otherwise you have another variable in there. You're all welcome to put in your own percentage or not as you see fit in your own model. One more question will come down over.
Richard from HRBC, just from my own mind. So does the change in price reflect any change to the size, frequency, distribution, or any other risk? And then the second, I might just be able to give more colour on the cost per tonne increase on the gram basis. Can you just give a bit of flavour as to what sort of matched up?
Okay, so the two questions there is there any change to our SFD? We can get Paul to answer that, and then can Grant spend a bit more time on the 190 rand per tonne. Paul, you want to?
Yeah, no, the SFDs are still the same. They're still the same, no change.
Off you go.
That was too quick. So, just to take you through the cost components, I think first of all, if you compare the cost components to what we had published previously, you'll see that there is a slight change. These prices, certain of the items that were related to OPEX were actually included in the same business in the previous capital model. We've now brought those out and reflected those in the operating costs. So what we're looking at here is a like for like. But the 2013 DFS, the costs that are reflected there are actually 2012 numbers. So the first thing we need to do is escalate those by inflation of 4.5% to 5% to get them into real money terms now. And when you compare it on that basis, it's actually only about 11% more. Now, I think back in 2012, Firestone was a very very different company. We had very very small staff complements. With the commencement of the project, we've obviously got a lot of highly skilled people around, and we've actually allocated each one of these. I spoke about these various cost disciplines. That we've got budget owners now for each one of these areas, for mining, for energy, for processing, for engineering, And all of those budgets have now been built up right from a zero-based principle. We've also done some. We've had to reallocate some of the costs. So previously we had quite a high energy cost, which actually included the diesel for running the mining fleet. We've reallocated that out. We've moved it into mining. But then on the flip side of that, you'll see that energy now we've restated it at 577. It's increased to 1040. Well, we've gone back and we've now recalculated the consumption based on every single item that's going to be used on the mine. We've used power correction factors. We've introduced capital to make sure that power correction takes place. So I think it's fair to say, that there's been a lot of additional work that's gone into redefining these costs going forward than what there ever was in the previous models. And certainly the numbers that we're now presenting have a far higher confidence level.
I think just the other way of putting it is we've got better definition of certain things. So as we went through all the equipment and we've updated it, you do trade-off studies when you do your feasibility, and you've got a selection of 3 pumps, and their rating is all to use, 2 watts an hour, as it were. We've come now 4 years later or 3 years later, seeing what's available on the market, and we've got larger capacity, but they choose larger power, but it makes you much more efficient in your plant. So there's all those trade-off studies are done there. So while the energy costs look like they're growing, in fact, our efficiency in the plant and the de-risking of that, but much higher energy going through certain pumps, but it pumps more material and does things like that. So what I've described as is better definition. We've put in a lot more engineering support. We've put in more supervisory labor into the plant and spares and mechanics. So we've de-risked this. And the other thing is we didn't just do this and then pray every night that the exchange rate would come and meet us and say, well, thank goodness for that, we were able to afford this. We've done it in a coordinated phase as we've gone through, and we've seen the deterioration. We have a whole risk log. I don't know how many risks we've got identified on there, Glenn, but it's in the hundreds. And we've ranked them, and then we say, well, we need to address that. Can we afford to do it? If we run this at 12 to 1, what does that do us with the extra cash flow? Not that we're spending the profit, but at some stage, those risks, if you don't manage them, come home to bite you. And we've been able to incorporate those in there. So operational readiness was a non-negotiable. We put that in, and that's why Grant has been doing the hedging and moving forward. And now that we've got ABSA on the hook, we've now got all of our guys, everyone's got skin in the game. You've ordered your ticket, but you haven't paid for it. You always have a choice. You don't have to go to the dance. But ABSA have now ordered their ticket in there. We've got the first deposit down, and they better come to the dance. So now they're very supportive of that. Both RCF and Pac Road are, fully committed to this. So I think when we build that all in our budget and looking at it, we want to deliver on this. So a criticism might be, well, how come you haven't had all this benefit from the exchange rate? But we've taken the deliberate decision to de-risk a lot of these things and put in the capital that is at the right levels. There's more players to this team. There's our plant manager. We didn't bring him, Gideon. Their role is to then meet these targets. It's not like we've done this budget and now you just get your budget and then I just see you once a month to say how you're doing. It's you've got to beat this. You've got to do those things. There's pressures from the community. There's electricity projects. Now, this is not a static model. It grows all the time with pressures and doing that. So I'm comfortable with that number of 192, that it's been thoroughly tested and pushed. And, we've pushed it down and we brought it up and told people you're not going to get that. Forget it. That's not how we do things around here. We've got to find a different way of doing it.
Sorry, I've got one more.
That's Grant, yeah.
Is that half mine cost?
No, my question was on hedging.
Okay, answer. Yep.
Just a question on the mine plan and the split shell and the increase in the bench height as of, let's say, geotechnically speaking, let's say in the lift long, they're broadly similar. You have to redo the geotechnics. Like when you went through North Core, did you go over the RTP again?
Yeah, very much so. It's I wouldn't say identical. It's very, very similar. Same terrain, basalt, country rock, and of course the kimberlite. We had the advantage of being able to go back to the previous records in terms of geotech. Same company, SRK, that signed off Red Sing, also reviewed our latest mine design and signed it off. So we feel pretty comfortable.
Any other further questions? Yeah, Nick again.
Could you elaborate a little bit on sales strategy? Is it going to be 100% auction based? And if so, of Europe or specifically Africa in terms of sales centre?
Yeah. I mean, let's assume the diamonds are all clean, and we're talking to government about where we clean them, and we're supportive of their strategy of what they're trying to do and beneficiate. But we've now got the diamonds ready for sale. Our current strategy is to sell them in the best market possible. We're not married to any market. When we were in the market previously, we were selling in Antwerp. It's still one of the biggest trading areas in the world, despite the Indian market and moving it to Botswana. Those goods leave Botswana almost immediately and are still traded in the secondary market. We now call it the secondary market in Antwerp. So our strategy is to sell them at the best possible place to realize the maximum value for both ourselves and government. Government have big stake in the royalty. We want to, make sure we maximize that. Our sales strategy is between, auctioning has benefits, but probably fixed tender, one single offer tender electronically done would be our strategy. We'll be moving on average about 120,000 carats, depending on how many sites we have or sales we have per year, and we stratify those between large and different qualities. So we're very flexible on that, around that. And I think that the other thing I didn't touch on is, you talk about this liquidity crisis. I haven't yet heard of anyone like Petra or Gem or Lucara say, I could have sold all my diamonds last week, but no one had any money. That's just not something that's happening. That happens in the guys selling 400 to 500 million, and there's a liquidity issue, and the pricing doesn't. But we haven't seen that. If there's money to be made in there, and there's people that make it, they find the money. Yes.
Can you just remind us what the debt guys look at pricing? How do they price going forward relative to how we priced here?
In terms of
their assumptions relative to the banks.
ABSA. Yeah. So when ABSA ran the bank, they just took 16% off the revenue. So we ran everything in the model, and then they took. When they applied, if we let them go, they would have driven the project to zero value, and then they may have given us some money or said, you can't afford to pay us. So they took 16% off the revenue. I think Grant was their first thing. And they took the plant efficiency down by 5%, and they added a recovery factor that we wouldn't get. And then we said, well, we don't need to detune the way we run the mine, because we can run it as inefficiently as you're modeling it, but we don't see any point in building something that can run exceptionally well to then run it at an 85% efficiency level. In that. So we've run those sensitivities on price. We're very close to ABSA. They're actually very supportive. We had them on site the same time with August, and the key event there was the lead ABSA guy drove his car into a ditch. He was reversing out while he was on his cell phone, and our safety topic of the day, which happened to be when he got to the mine, so he didn't get the timing quite right, was don't drive and talk on your cell phone. No, very supportive team. Really, they understand what we're doing and go there. So they're in as well. So effectively, we've got the South African government in there. They're underwriting the ABSA debt, as you know, through the EC, Export Credit Insurance Corporation. We've got that policy issued and paid, so all good on that. Any other questions or anything? Great. Well, thank you very much. I believe there's light lunch out there if you want to grab any of us now and ask us a question you want a further answer to. We'll be around for the next while. The minister's here, and appreciate it. And we'll be updating you further as we make more progress. Thank you very much.